Hello. Hi, everybody. Okay. Slides are working. Welcome. Hi, everybody. So, welcome to another webinar of our series. Today, guys, we're going to talk about fundamental analysis. We're going to do a small introduction. We're going to outline, in a sense, what stuff are we going to be talking about in this session and then next to come. So, we're going to do a brief intro into fundamental analysis in this session. We can outline the four key pillars or the four main kind of categories of economic news releases that fundamental analysts look at. More specifically, we're going to deal with inflation and interest rates, particularly. And on the next session, we're going to do growth overview alongside an employment overview. So these are the four main pillars, at least from my point of view: inflation, interest rates, growth and output, but also employment. So today we're going to do the first two. Next session, we're going to cover the rest. Okay, so I'm going to allow a few more moments for the people to join. By the way, for the guys that are already in the chat, can you hear me loud and clear? Can you see the first slide of the presentation? If yes, please give me a thumbs up in the chat to see whether the chat is actually working properly as well. And if yes, we're going to be shortly on our way. So, okay. So I think everything is running up nicely. Okay, perfect. So let's begin. So this webinar, again, introduction to fundamental analysis. One of the two main schools of thought when it comes to trading. Okay, some people like to use solely the technical analysis kind of route. Other like to combine technical analysis with fundamental analysis. Some of them like to look only on fundamental analysis and do their trading. Again, I'm gonna be saying this throughout the entirety of this season or this series. If you manage to learn the principles of both technical and fundamental analysis, this is gonna give you, in a sense, a holistic kind of approach. You're gonna know what's going on in the wider international financial markets, and then you can zoom in onto the daily kind of matter of things and actually do your trading plan, execute your trading plan. So knowing both technical and fundamental analysis, from my point of view, from my humble opinion, is the ideal kind of mix of the two that can give you extra sensitive information that is going to be used for you to become a much accurate trader, or going to have much more high probabilities of placing trades that are going to be profitable and winning. Okay, so besides that, let's get started. This is a quick risk warning and a disclaimer. I'm not going to go over the whole thing. You can read this at your own time. The gist of the whole thing is, anyways, that throughout this, give me a moment, please. Throughout this webinar, whole thing is going to be about narrative. Whole thing is going to be surrounded by is for educational purposes only. In other words, it does not contain any sort of investment advice or investment recommendation. So again, this is for us to learn. Okay, so moving on. What will be covered in today's session? This is the agenda. A brief overview of what fundamental analysis is. We're going to go an overview on inflation and interest rates, but also growth and employment. Again, we're going to focus a lot of attention on the first two categories, inflation and interest rates. Next webinar, we're going to do growth and employment. Okay, so this is the structure of today's webinar. Let's begin with what is fundamental analysis. This is the broad definition that you can find when you just type fundamental analysis on Google or whatever other search engine you are using. So fundamental analysis as such is the study of economic and political forces and how, at the end of the day, they determine or influence the valuation of currency exchange rates of countries. Again, this is a more quote unquote calibrated or specific definition because it talks about currency exchange rates. When we do fundamental analysis in general, it's not only about FX, it's about companies as well. So, for example, fundamental analysis when it comes to equities or indices or whatever that is um, ideally looking at financial statements, looking at uh, balance sheets and cash flows and all those kind of reports and making an assessment on an individual company and then trading upon it. So the idea of fundamental analysis in general, okay, is keeping up what is going on, more specifically with the FX market, is keeping up with what's going on with nations, with countries. And since we have many nations and they have their respective currencies, what we're dealing here in the FX market is looking at an overview of different nations, how they perform against each other, okay, with the purpose in mind is to get an edge, okay, and see how their FX rates, okay, the relationship between these two currencies, these two countries, for example, the United States and the United Kingdom. So we're talking about the pair GBP USD, the pound against the United States dollar. How is that pair? How is that FX rate going to fluctuate depending on the information that we will be studying? And this kind of information is pretty much economic data that gets released periodically throughout the week or weeks throughout the entirety of the year, and gives us valuable information about how these economies are behaving. And by understanding how these economies are behaving and what is their trajectory in regards to the growth aspect of things or the inflationary aspect of things, we get information about that and we make projections about how their currencies will perform in the near future. Okay, so this is the whole idea of fundamental analysis: study of economic and political forces that determine how these exchange rates behave with each other. Okay, and the political aspect is also super, super, super important. The ones that are in charge of governments and they are in charge of fiscal policy, they do have severe effects on their nation's economies, and that's why we study the political aspect of things as well, not only the economic aspect of things. Okay, so we're going to discuss a lot of examples to make sure you understand exactly how the whole thing affects each other and exchange rates. And again, this webinar is going to be super basic and brief. In the next webinars, we're going to do a little bit of a more of a deep dive and see what actual releases are coming out periodically and how they actually affect and how to read and study these kind of things and make your own conclusions. Okay. Obviously, there is a subjective aspect to things, but there is also, is an objective aspect to things as well. So therefore, let's go back to the slide. Fundamental analyst looks at economic indicators, okay, that give them or everyone a sneak peek of how an economy is performing. So analyzing these data allows fundamental analysts to assess the situation and come to a conclusion on how to position themselves in the market. Okay, pretty generic for the time being. If you have any sort of questions, please send them through in the chat and we'll be more than glad to answer them. For the time being, we're keeping it simple, we're keeping it generic. But as we progress, as I said, we're gonna add a little bit more complexity to things. Now is for you to get familiar with the concept of fundamental analysis. So fundamental analysis is primarily used and applied for medium to long-term kind of durations as the market events unravel. However, it could provide valuable insights in the short term as well when combined with technical analysis. So primarily given the state or given the structure of fundamental analysis, because it looks at macroeconomic events and macroeconomic indicators and releases. These are reports that evolve over time. These are numbers that evolve over time and they paint a picture right in front of your eyes. So most of the times when we're talking about fundamental analysis, we're looking at a much longer kind of horizon. But if you actually zoom in on a daily kind of event when something is going to be announced, you're going to see that there is actual fluctuations and in a sense the release is affecting exchange rates of countries. You can use that on a short term as well. You can use fundamental analysis on a short term as well, but primarily most traders use technical analysis when we're talking about the short term, for example, trading within the day or trading within minutes or trading within a few days. Okay. Fundamental analysis takes a lot more kind of zoomed out kind of perspective. It takes a lot more time to materialize and see the actual effects of how these things are interrelated and they are affecting each other. Okay. So without further ado, let's go in with the first category, which is inflation. Okay. So I'm pretty sure, I'm hoping that every one of you guys know what inflation is. If not, fear not, we have a definition right here. So to make you grasp the concept. So inflation is essentially the rate at which the general level of prices for goods and services are rising or falling. Okay, so we must say that as well. So another way of conceptualizing inflation, it is in a sense the measurement of the loss in the purchasing power for every unit of currency per year. Again, if this is not clear yet, allow me to present you an example. It's going to make things easier. So inflation, before we go into the example, inflation is measured most of the times as an annual percentage. So for example, 5% year on year. When you hear someone say, what is the inflation rate currently? Most probably they're talking about the rolling 12-month period. So an average of the past 12 months. This is what we get, so the yearly average. However, some people like to also look at the monthly or even the quarterly basis, depending on the economy. For example, Australian economy or the New Zealand economy, we tend to look at the quarter-on-quarter kind of basis. That is how the economy, that's how economists are actually looking at that, and that became a tradition. So looking at, for example, the growth prospects of the Australian economy over a 3-month period of time. That's how it's done. Monthly is pretty much applied by each and every country, but primarily most people, when they look at the inflation rates, fundamental analysts look at the inflation rates, they look at the annual kind of percentage. Okay, so a smoothed out kind of average gives you an overview or a broad kind of perspective on what is the inflationary problem of that economy. So again, moving back to the example, to understand what inflation is. So let's just say, for the sake of the example, that inflation currently is at, or not currently, but in general, is at 10% on an annualized basis. Okay. So what that means is essentially that a loaf of bread, because we're talking about inflation, excuse me, calculates the basic level or the general level of prices for goods and services. Bread is one of the most common and most widely used kind of, not commodities, but items or goods that is out there. We take that widely used product and we make assumptions out of it. This is what we're trying to do in this example. So what this means is that essentially a loaf of bread that costs $1 in 2021 will most likely cost $110. A loaf of bread that has been priced in at $1 a year later, let's just say now we have 10% inflation, that is costing $1.10. So that means the $1 buys you less stuff, okay, in 2022 or 2023 or 2024, whatever that period is, compared to the year beforehand, where we had a much lower inflation rate. Okay, so let's assume that we have 0% and the next year you have 10. So $1 gives you a bread in, for example, 2021, 2022, we have 10% of inflation. Now bread costs $1.10. Again, at the end of the day, you buy less stuff with the same amount of money. That means your currency gets, quote unquote, devalued. Okay, or at least your purchasing power gets diminished if inflation is rising. Okay, so over the past few years, as you may recall, we had a majority of pretty much all economies facing rising inflationary pressures. Thankfully, that is not the case in 2024. Inflation is still a problem, but is not as big of a danger as it was back in 2022 and 2023. Currently have a lot of progress on that front, but that's the whole thing. That's the whole aspect of things. When economic calamities kind of arise, inflation gets, or for example, I'm not going to go into many details here. When bad stuff happens and we have a shortage, for example, in supply, most likely you're going to see an a rise of inflation. Or when you have an economy that is actually booming and you have a lot of people thirsty to consume, that also fuels inflation, which tends to raise prices of basic goods and services, which is what is the problem from the point of view of central banks. And we're going to introduce central banks right now, which their issue or their mandate or their goal is to keep inflationary pressures at a sufficiently quote unquote low level in order to allow the economy to grow steadily and not have the adverse effects on consumers. Because if you have an economy that has, for example, 25% inflation, general inflation, you tend to place this whole thing, in a sense, brings a lot of problems to consumers. And if consumers do have a lot of problem and they're not spending because the prices of goods and services have gone up and now they're spending less, this is going to create a problem for the economy. And therefore, what central banks do is rush and restore that balance of the inflationary problem by deploying their relevant measures. We're going to discuss them in order to bring inflation back down and keep the economy, their economy, growing steadily at a predictable kind of manner and allow this nation to prosper. So you're going to see a few examples to understand the importance of inflation and how degrading the effects are, and the how important it is to keep it, how important it is to keep it on balance. And we're going to do two examples. One is going to be hyperinflation, the other one is going to be deflation. Two extreme scenarios, I have to say from the beginning, but these are examples that are being studied by central banks, and they are examples that are being studied and by all means are attempted to be kept away from coming into an economy because they have catastrophic kind of consequences. And you will see what I mean by this. So hyperinflation, let's begin. This is the first example. Hyperinflation is, in other words, the rapid rise of prices, okay, for goods and services. And practically this makes the buying and selling of stuff practically, but also not buying, makes the buying and selling of stuff much more difficult for consumers, but it also degrades the value of that country's currency and makes it practically worthless. And you will see the example here. So one of the worst instances of hyperinflation was observed in Zimbabwe. So back in 2008, inflation was estimated to be at 231 million% on a year-on-year. So this means that a lot of bread, in order to conceptualize it, a loaf of bread in Zimbabwean dollar in 2007 was worth $1. In 2008, this was worth 231 million in just 1 year later. So this is destructive. This is the utter destruction of purchasing power of the consumers of that economy. This is a big problem. This has happened to Zimbabwe. And try to imagine planning your personal expenses or business investment or savings in such an environment. It's practically unattainable. Okay, so imagine going to the supermarket to buy a loaf of bread in, I don't know, 2007. You pay $1. Okay, get your job done, go home, eat. In 2020, excuse me, in 2008, you had to go in the store with bags full of cash in order to buy the same item due to hyperinflation. Okay, and how do you fix this situation? This kind of situation was an utter failure of an economic system, you can go ahead and read this study. Super important, super intriguing at your own time. We're not going to go into details here, but pretty much it led to the collapse of the economy. There was some external intervention measures by the IMF and many other overseeing kind of banking communities that went ahead and attempted to fix the situation. Again, the reason why we're putting forth these kind of examples is to make sure you understand what the extremist form of inflation are and how destructive it can be for the economy. There's some economies that have, for example, currently, if I'm not mistaken, Turkey, for example, has a 90% of inflation. And the whole thing is super, super, super dangerous. And it's not at the extent of Zimbabwe back in 2008, but the authorities are attempting to fix the situation by adjusting the conditions accordingly. We have some interventions by the Turkish Finance Ministry. We have some interventions by the Central Bank of Turkey, which raises interest rates in order to tame this kind of situation. But there are a lot of things that can be done. But at the end of the day, if this kind of scenario arises, is pretty much too late. And that's why central banks pay close attention to inflationary pressures over a period of time. And that's why they have set policy decisions, monetary policy decisions, every 6 to 8 weeks in order to make sure that this scenario does not come into fruition. This scenario is not being allowed to materialize, and they do their policies, they deploy their tools, their available tools in order to contain this from happening. And now we're going to move to the next example, which is the complete opposite. So hyperinflation is when you see high rising of prices, rapid pricing rises. Deflation is the complete opposite. Okay, and some may say, what's the problem with falling prices? Okay, you're going to see. So the opposite of inflation is called deflation, which is on a general level, or the definition of deflation is that a decrease in average prices. And most of the time, we're talking about severe deflationary pressures here. So if prices are falling constantly, okay, month after month, at the end of the day, people do have an incentive to wait before they buy things. Okay, so this, in other words, hurts the consumption function of that economy. That means most economies are thriving purely from um, selling stuff to consumers, or from consumers that are actually buying stuff. For example, if you look at the United States economy, its growth kind of model, or primarily the prime contributor of its GDP, it's 70% is attributed to consumption. So if something goes away, if something goes awry in the United States economy, and for some reason consumers are not buying enough, okay, they're not recycling the flow of money within that economy, because when you buy and sell stuff, you can keep the money flowing within the economy. It creates new opportunities, creates these investment opportunities for international investors to come and put money into your economy to capitalize upon this rapid growth. If enough people, or if a large proportion of market stops for some reason to consume, this brings down the overall level of growth within the US economy, and it stifles innovation and keeps it forces jobs to start closing and all that kind of stuff, because they are not actually bringing money in by selling stuff. Okay, so consumer is one of the most important mechanisms or cogs of the wheel of the machinery of economies. So that's why consumption is super important. And in this example, when we have deflation, okay, when we're talking about rapid fall of prices, and you have the incentive to, say, what, why bother buy something today, okay, when something costs, for example, $100? If, for example, next month that item from $100 is going to fall to $90, there's no need for me to go into store and buy this thing. Okay, I'm going to wait it out, okay, for the next month or the month after it, in order to get it, quote unquote, on a discount. This is the effect of deflation. In other words, so if enough people have the same mentality, the same rationale, the same point of view, and they say, you know what, I'm not going to go out and buy this kind of t-shirt or this kind of pair of pants or this car or this PC or whatever that is, or mobile phone number, because I'm expecting next month or in the next 6 months that its price is going to fall. And again, what's the point of buying it now? I'm going to buy it later with less money. Okay, going to have much larger purchasing power, if you like. If enough people do that, okay, this brings the whole consumption function of the economy down. Okay, deflation rampantly ravishes and becomes stronger. And this has the potential, if enough people do that, has the potential to plunge an economy into a recession, okay, or at least have an unfavorable kind of development in terms of growth. So growth is an essential part of economies. Consumption is another important aspect of economies. Now also, for some reason, not for some reason, but for the realist reason, it does fuel the growth of an economy. So when you have falling prices, this is no good. And people and central banks do intervene once again and deploy their relevant monetary policy practices in order to not allow this scenario from happening. So again, at the end of the day, let's summarize this and move onwards. If prices are falling constantly, people have an incentive to wait before they buy things. So why buy the car you want today when you can buy it next year or next 6 months for 1 or 5 or 10% lower? But if everyone thinks like that, demand in the economy collapses and we enter a recession. That is the natural cause of things. If the consumption of an economy, it gets stifled or gets problematic from rising deflationary pressures. Okay, so again, at the end of the day, this forces companies to close down, people to lose jobs, and if people do not have jobs, they don't have money, and if you don't have money, you're not gonna spend. If you're not gonna spend, this is gonna create a slump. And this is the reason why central banks do pay a lot of attention on inflation. Hopefully, these two examples of deflation and hyperinflation have given you a brief idea of how the whole thing works. Again, I know it's super generic, it's super theoretical, okay? You may say that. But this is an introduction to fundamental analysis. Next webinar, we're going to do a deep dive on how they actually affect this. Okay, so moving on to the next topic, the next category out of the 4 that we're going to be discussing today. We covered inflation. Now we're going to cover interest rates. What are interest rates? This is, in a sense, the blunt, the not sharp tool that central banks do have at their disposal at addressing the inflationary problem. So when you have inflation above a pre-agreed level, which most economies have a 1 to 3% kind of range, if inflation, for example, in the European Union is higher than the 2% target, which it has been over the past year or so, we have seen an inflationary pressures reaching as high as 10% or more. That is a problem. Again, this signals to the central bank that hyperinflation may become a reality. So therefore, what do central banks do? They start raising interest rates. Why is that? We're going to discuss this. So when inflation rises, this is the second scenario. If inflation rises above the 2% target, the 2% target is a arbitrary kind of level that for some reason central banks agreed that this is the most decent or the most appropriate percentage level for inflation to be in order for the economy to grow steadily over the next, I don't know, 5, 10, whatever years. So again, arbitrary number 2%. If inflation is above that 2%, what central banks do is tend to raise interest rates in order to bring inflation back down. And how does that work? If you raise interest rates as a central bank, you inadvertently, like it or not, you are going to be placing pressure on consumers that do have loans with banks. Let me explain what I mean by this. So if the central bank, if you have agreed to enter a loan to finance your housing, project, okay? You want to buy a new house, okay? You're going to build a new house, okay? So you go to the bank because you don't have enough money. If you do have actual cash to go ahead and do that, perfect. No need. You are not part of this example, but most people do have loans for their homes, okay? So when you go to the bank and you agree that, you know what, I'm going to be paying you over the next 30 years a small amount in order for me to start my house now. You know how loans work and how housing loans work. And we agree upon a 2% kind of interest rate on a month-on-month basis, okay? And for some reason, inflationary pressures, something happened, and they go from 3% to 10%. And you see central banks rushing to raise interest rates, the 2% that you have agreed. And if it's variable, most loans are variable. This 2% that you pay on your 100,000, nobody buys a home with 100,000, unfortunately. Let's just say you've got $300,000 kind of loan in order to buy a home, and you have to pay interest payable of 2% for that house per month. Or let's just say just give a random number, 6%, excuse me, $600 per month to finance your house. And central bank raises interest rates from 2% to, within a few months, to, let's just say, 4%. You're gonna be forced to pay that additional 2%. It's not always like that. I'm simplifying it a lot. So instead of paying 2% on your loan, you're gonna be paying 4%. So double what you would have initially paid per month. So 600 would have become 1,200. So imagine a lot of people that live paycheck on paycheck, have loans, and the central bank raises interest rates. This is going to bring a lot of issues on them. This is going to stifle, this is going to contain, okay, their purchasing power. They will not be having a lot more available free funds, because from going from $600 paying your loan to 1,600 and 1,200, double that, you have $600 less to spend on your, I don't know, vacation or your food or your transportation or leisure, whatever that is. This indirectly affects how consumers buy and sell stuff within the economy. So raising interest rates, that's what central banks attempt to do when inflation is too hot, because we have high demand or supply shortages. This is what central banks do: raise interest rates in order to contain this rapid demand and discourage discourage consumers from buying excessively. Okay, so forces them to contain their spending in order to bring inflationary pressures down, because they're primarily driven by excessive demand. That means a lot of people want to buy a specific item, and that specific item is not available for everyone. So apparently its price is going to move to high ground in order for the company to make much more profit, fortunately, but also to tend to those people that have most money, or those that are willing to pay top bucks in order to get it. For example, when it comes to gasoline or petrol that you put in your cars, it has something to do with demand and supply, but more it has to do something to do with demand, but most of the times it has to be with supply. So when you have supply shortages, for example, those economies that drill and refine and put in barrels the oil and sell it to the market. If these economies, if these countries, for some reason, they decide, you know what, I'm not going to be drilling and I'm not going to be drawing oil from the ground for X and Y reason, this is going to have an impact on oil prices, because you have a global economy that is thirsty for energy, more specifically crude oil or whatever that is, petrol or gasoline or whatever that is. Okay, if the demand is high and you don't have enough petroleum or enough crude oil or whatever that is flowing the markets, you have a lot of people wanting the same thing, a lot of people wanting the same thing, and you don't have enough of them for everyone. At least that's the basic economic graph function behind it. Tends to lead to higher energy prices, because same people are competing with less resources, okay? And these resources and this lack of resources is primarily controlled by those who produce petrol, okay? So in an overview, that's how and that's why central banks go ahead and raise interest rates when you have inflationary problems. Okay, so central banks tend to focus on controlling inflation. Is one of the two mandates. Most central banks have at least the one, which is inflation. That is their primary job. Okay, if inflation goes above, you do raise interest rates. If inflation goes below the target, you tend to cut rates in order to stimulate growth. Okay, we're going to see the examples. So as a matter of fact, most central banks have a mandate to keep inflation as low and steady, somewhere around the 2% per year. This is, again, an arbitrary number that they formalized back in 1996, if I'm not mistaken. The New Zealand central bank was the one that introduced this kind of arbitrary 2% target for inflation, and then it was adopted by many other central banks afterwards. Again, arbitrary number. So scenario, when inflation falls below the 2% target, the arbitrary number, central banks usually lower interest rates in order to boost inflation. Okay, we have covered the second scenario. Let's cover the first one now. So below the 2% target, that means we are venturing into deflation territory. Okay, so rapid fall of prices, maybe not rapid, but steady fall of prices is going to create this scenario if it's left unattended. So why buy something now when I can buy it few months down the line cheaper? So this gives an incentive of consumers to stay away from purchases. Again, staying away from consumption brings down the overall growth of the economy. So what the central bank attempts to do is lower interest rates because, in a sense, they want to give out free money around, let's just say if it's 0% interest rates, you're going to bring it down to 0% in order to make getting money and stimulating the economy indirectly via cheaper loans to go out and do things in order to keep the economy running. So get that money and invest it, or get the money and buy stuff, or in a sense, keep the flow of money circulating within the economy and re-stimulate inflation. Because if it's left untended, okay, it's going to probably lead to deflation, which is a problem, which can lead to catastrophic events such as a recession, or in the gravest terms, a depression. Okay, much not that likely. Recession is something where we pretty much see every 8-year cycle. So yeah. So scenario one, when inflation falls below the 2%, you cut rates, you slash rates to stimulate the economy by giving funds, pouring funds into the economy in order to keep it going. Whereas inflation above the 2% target, inflation gets out of hand, has a problem on consumption, and because we have high demand for goods and services, central banks tend to raise interest rates in order to, let's just say, contain this kind of over exuberant demand from consumers. So, well, in a nutshell, what you're trying to do, what central banks are trying to do, is create an equilibrium or a balancing point, or balancing the scales between not too high and not too low inflation. So again, their target is 2%, and those are the tools that deploy the interest rates in order to kind of stabilize the whole thing. Okay, because that is their sole purpose. No sole, but some other central banks have two dual mandate, but still, the primary objective of a central bank is to keep inflation under control, and that's why we do care about inflation and interest rates. Okay, so interest rates and inflation, it's all related to demand. I've pretty much explained this over the past few slides. I'm going to do this once again in order for you to digest it. Okay, so in the first scenario where we had deflation or inflationary pressures being below the target, central banks lower rates to stimulate borrowing. In a sense, they tell you, you know what, you can get money from me with 0% interest. So in other words, free money. That has been the case in the Eurozone for the past, not for the past, from the 2008, maybe 2010, after the global recession, until 2016 or 17, we saw pretty much zero interest rates for borrowing, okay, funds. So that means, what, indirectly says to the market, your money, get free, it's free, take it, okay? No need for you to pay interest on it. Okay, you pay a small amount, but it's nothing like what we see currently. Okay, and at the end of the day, this is attempting to stimulate borrowing, stimulate consumption, stimulate, circulate the money within the economy in order to create a prosperous nation, or at least lay the foreground for a prosperous nation. So higher borrowing means more economic activity, because you have free money, you tend to spend it, you don't sit on it. You can't sit on it, to be honest, which usually leads to higher demand and thus higher prices overall. And once again, if enough people start getting these loans to start a new business, or to fund their houses, or to buy a new car, or whatever it is, you are buying stuff, you are consuming within the economy. If you're consuming within the economy, you tend to have higher demand for all those goods and services we just mentioned. And therefore, if you have higher demand because you have money to spend, it tends to lead to higher prices overall, reignition of inflation at a healthy level for that economy to grow. That's what it is at the end of the day. So lower rates, okay, leads to higher borrowing. Higher borrowing leads to an increase in economic activity, as we see, consumption, and this increase in economic activity leads to higher demand, and therefore this leads to higher prices. So problem solved. When inflationary pressures fall below the target, central banks cut rates to, in a sense, trigger this chain reaction in order to solve the problem. Now, in the second scenario, where we had inflationary pressures above the 2% target, the central bank more specifically, tends to raise interest rates to curb high inflation. So it's the opposite scenario. We have a lot of people, high demand, prices are keep going higher and higher and higher and higher and higher. People are thirsty to buy stuff. What central banks do is they increase interest rates, they lift interest rates in order to lower borrowing, okay, create unfavorable conditions for those that spend too much to spend less, okay? So this leads to lower borrowing, which lower borrowing means less economic activity. You're not getting loans to create a new business or buy a new car, or create a new service, or whatever that is. So if it's a slowdown in economic activity, it tends to lead to lower demand, because people get it. You know what? I cannot afford buying this now. Okay, price is too high. Going to stay away. Demand for that product, if this mentality of rationale is followed by a lot of people, it tends to lower demand. And if you see a slowdown in demand, you tend to see a slowdown in prices as well. Okay, this is the whole rationale of Ethereum. So how do interest rates and exchange rates behave with each other? Why do we give a damn about interest rates and inflation? Because raising interest rates usually causes a currency to strengthen. Okay. Also, reducing interest rates usually leads to a weakening of the currency. This may seem puzzling for you, but this example is going to make it clear. So you can think of these reactions in the context of how much you get to save your money at the bank. So we're talking about borrowing and lending from banks as consumers. Okay, this is the setup. This is context. So if Australia, for example, or the central bank or the Reserve Bank of Australia, RBA, suddenly raises interest rates because inflation is way too high, it becomes a more attractive place for international investors to save their money. Okay, because when you raise interest rates, it's not only and you have a loan, you are, in a sense, a borrower from the bank, correct? Okay. So you go to the bank and you borrow money, and the bank is your lender, correct? If you have a loan. But if you have an account and you don't have a loan and you just keep your money in the bank, okay, you are not a borrower, you are a lender to the bank. The bank is the borrower. So it's the opposite kind of dynamic here, okay? So if you have money and an economy or a central bank raises interest rates, okay, usually international investors that have a lot of money that they move around and capitalize upon these things, they start to switch. Okay, for example, if they're overseas, they move in and they see this kind of development by the Central Bank of Australia. For example, let's just say you are a US citizen, okay, and for example, RBA raises interest rates. As a United States citizen, okay, that you have dollars in your account, you see Australia raising interest rates to 5%, and in the United States, the interest rates is at 2%, 3% more. So what they do, in a sense, is get their money and put it in Australian denominated accounts and get interest receivable, okay, because they are lenders to the bank, okay, at 5% compared to the 2% that they got from the United States, their domiciled kind of country. Okay, so this is the attractive part for international investors, and we're talking about the big fish here, the people that do have a lot of money and they move it around and capitalize upon these things. So it becomes more attractive place for international investors to save their money in. So in order to save your money, for example, in Australia, you need to have Australian dollars because that's what they use down there. So if you have United States dollar or euros or Japanese yen, whatever that is, okay, you sell your domestic currency and you buy the foreign currency. So you sell your local currency, the dollar, the euro, the Japanese yen, whatever that is, and you purchase, okay, Australian dollars, okay, and you keep it in the Australian dollar denominated account in Australia in order to get the interest receivable, okay? So what you do, that transaction of selling your own currency and buying the other one, that's what leads to higher, okay, strengthening of that currency. This is what supercharges that currency because there is a transaction, an exchange of value, a buying, a selling of currency in order to get another one, a selling of a currency in order to get another one to facilitate your needs, your goals. Okay, so that's how the whole thing unfolds. This is what leads to higher demand for the Australian dollar because you have favorable, okay, interest rates regime in the Australian economy compared to another economy because the interest rates in Australia are higher than the ones in Europe or in Australia, in the United States or in Japan, in wherever that is. Okay, do you tend to capitalize upon the fact that the Australian economy has higher interest rates by moving your money there, by selling your local currency and buying a domestic currency, which in this case is Australian dollar, to get interest receivable on your deposit. Okay, so these demand, this flow of money, this selling of foreign currencies to get the domestic, the Australian dollar, usually leads to the currency strengthening. Okay, is it clear? Okay, that's how international investors behave when they see these kind of discrepancies between nations. You can clearly see that with any major economy versus the Japanese economy right now. Japanese economy has what, 0.1% of interest rates. In the United States, you have what, 5.5. So there's no comparison there. Japanese investors flee from Japan and go to the United States. They sell their yen and they buy dollars and they use those dollars and get interest payable, interest receivable on them. And the fact that they sell the yen and buy the dollar, this strengthens the United States dollar and it pushes lower the Japanese yen. And that's why you saw, if you pull up a chart of dollar yen over the past few years now, you see the rapid devaluation, the weakness of the Japanese yen. This is primarily because of this. Okay, and this is why we have seen the yen being pushed to 38-year lows, because every other major economy, okay, it's not only the United States, it's the European, the ECB as well, the BOE, the Bank of England as well, Australia as well, New Zealand as well. You see a mass fleeing of Japanese from the Japanese yen and going into other currencies in order to capitalize upon this net interest differential that the two central banks have. For example, Bank of Japan with the ECB, or the Bank of Japan with the BOE, or the Bank of Japan with the Federal Reserve, etc., etc., etc. Okay, this is how things work. So, finalizing this kind of scenario. Conversely, if we see Australia cutting rates, their currency becomes less attractive. Again, for the same reason, once again, if there is an economy that there is high interest rates, and this one you have your money in after the migration, start cutting rates, it's more attractive to have your money somewhere else rather than in Australia. So you take the opportunistic approach whenever possible. So this leads to less demand for the Australian dollar, so fleeing from the Australian dollar, selling of the Australian dollar in order to get the new currency, and therefore what is left is a weaker Aussie, is a weaker Australian dollar. Okay, and this is not purely with Australia, this is pretty much the interrelationship of how things work with interest rates and exchange rates. This is between any given economy. Okay, that's it. So why do some central banks look at exchange rates? Okay, so how strong or weak currencies definitely has implications for inflation. Okay, so it's a positive feedback loop, if you like. So as such, central banks tend to pay attention to the exchange rate. A weaker currency means that your exports as a nation become much more competitive abroad, since they're cheaper for the other people to buy, for the foreigners. But it also means that your imports in your own country are going to become much more expensive because you have a weaker currency. Okay, so this leads to higher prices, meaning it's going to lead to higher inflation. Thus, if you are a central bank trying to raise inflation from 1% to 2%, let's just say, a weaker currency might indeed do the trick for you. Okay. See, for example, PBOC, People's Bank of China. They're currently this kind of situation right now. Okay. So on the other hand, however, a stronger currency brings the price of imports down because you have a stronger currency, you can buy more stuff, which may hold overall inflation in your economy down as well. Okay, so enough about this. Let's move on to GDP and then employment. Brief overviews. Next webinar, we're going to go much more in depth, much like we've done with inflation and interest rates. This is for you to keep an eye on what's coming up. So then the remaining two categories, okay? GDP, or growth rates, and employment. So GDP, hopefully you are familiar with the term, is what we call the gross domestic product. This is GDP is an abbreviation of the gross domestic product, which is considered to be the broadest measure of a country's economy, and it represents the total market of all goods and services produced within a country during that year. Okay, so if your economy is creating, let's just say, manufacturing equipment or cars or whatever that is, those are goods and services, more specifically in this kind of case, goods that are being produced within your economy. They have a value if you combine all the stuff that was produced, okay, within that year of that economy, okay, and you add its value all together, it gives you what we call the GDP. So the higher the gross domestic product, the stronger the economy is. And it comes in a percentage kind of manner, which is easy to keep track. So at the end of the day, GDP is the most important. If you're going to remember something from GDP, is this. It is the most important growth metric of a country's economy. So if you have, again, a high GDP rate, okay, at least higher than other economies, international investors want to do business with you. that is a signal that your economy is healthy and it is thriving, and they want to put money into your economy to create new jobs and capitalize upon this growth and make money for themselves. Okay, that's why GDP is important. It also gives you a broad level of wellness and well-being of that, how that economy is behaving. Okay, higher GDP tends to lead to higher quality of lives is for the citizens of that economy. Obviously, we're talking about the distribution of money is not always evenly outlaid, but that's the main idea behind it. This GDP print, high GDP print tends to be seen as an attractive factor for international investors to put money into your economy. Okay, so it's the most important growth metric of the country's economy. So in a nutshell, it provides what we call a health status update on the country's economy. So rising GDP rates signals growth in the economy, which leads to stronger currency because they sell their own currency in order to buy your own currency to set up businesses in your own country. Okay, so this is good news. However, on the flip side, when you have falling rates of negative GDP rates, it signals an economy is stagnating or struggling or is having problems, or it may face a deflation, not deflation, excuse me, a recession, okay, which is something that tells international investors, you know what, stay away from this economy. It has no prospect of bringing or increasing your wealth, or this is not a proper investment kind of opportunity. So staying away from countries that do have negative GDP rates or stagnating GDP rates. International investors tend to prefer economies with strong GDPs. Strong GDPs leads to stronger currencies. Weak GDP leads to weaker currency. Okay, so next slide is employment. Again, fear not, we're going to see them in depth in the next webinar. So employment, when it comes to employment, fundamental analysis monitor key metrics when it comes to employment in order to assess the tightness of the specific economy's labor market. Okay, so we're talking about the people that are able and willing to be working within an economy. Okay, and why do we care about this? Is because the more people we have, the more strong the labor market is, the labor market force, the more employment market is, the stronger it is. Okay, this is perceived as super good news for international investors. Once again, they want to set up offices into your own country because they want to capitalize upon this excess strength of employment. They want to set their businesses here, okay? But at the end of the day, it has also to do with consumption yet again, because if you are employed, if the majority of people within the country are employed and they get enough money to not only survive, but also thrive, this means that they're going to be spending money to buy stuff, probably stuff they don't actually need, but just for the sake of it, purchase stuff. And the purchasing of stuff, the consumption of stuff leads to the cycle we just explained many times over this webinar so far, okay? Which leads to higher consumption means higher GDP, which is the growth rate we just saw, better opportunities for international investors to invest, and you amplify, create a positive feedback loop, which raises the overall kind of level of your economy to higher ground. Okay, so high employment within a country is a good sign that the economy is doing well, and in contrast, low employment, or in other words, high unemployment, usually signals weakness in the economy and is reflected in the currencies in valuation. So if you have a lot of people that are not working, they're not contributing to society, they don't have enough money to buy stuff, again, this is a bad signal for the economy, and therefore, if people are not willing to invest in that economy because it has a high unemployment rate, that country's currency is most likely going to be facing pressures. Okay, so closing by this category of employment, we have to outline a few metrics that we do see, few economic releases that come out periodically, and we do pay attention to them, such as The unemployment rate, super important. Initial jobless claims means people that lost their jobs or they have quit their jobs to just file for unemployment benefits to get subsidies from the government in order to find a new job or not. Okay, this is what initial jobless claims. So higher number of initial jobless claims means a lot of people are unemployed. So that's not good news. Tend to see a negative reaction of the that country's currency. And other metrics are what we call the non-farm payrolls report, NFP. Hopefully you have heard about this. It has a big impact on the FX community. This closely watched. And these are some of the main ones that are giving you an outlay of what labor market of that specific economy is doing. Okay, again, we're going to see them in depth in the next webinar. Okay, what would you expect in the next webinar? Okay, finally closing up is going to be growth and employment, growth and output and employment as well. These two categories are going to be studied much more in depth, much like we have done with interest rates and inflation rates earlier today. Okay, so this is going to be the structure of the next webinar yet again. Okay, so this is the end of today's session, guys. Do you have any sort of questions? Please send them through right now. If not, we're going to leave it at this. Okay. No, I don't see any questions. Okay, fair enough. Have a lovely weekend, guys, and hopefully see you next week for the second part of this webinar. Okay, for the time being, take care. Bye bye.